I need you to stop scrolling right now. Okay, look at this chart. Take 5 seconds. Don't read anything else. Just look at it. You're looking at Bitcoin on the daily time frame. And what you're seeing is not random noise. It's not chaos. It's a story. And that story has 3 possible endings. By the time this video is over, you'll know exactly which ending fits you. And more importantly, you'll know why. Here's what the chart is telling us right now. Bitcoin dropped from nearly $100,000 to $62,000 in less than 4 weeks. A 35% collapse. Vertical, aggressive. The kind of move that wipes out leveraged positions before most people even open their trading app in the morning. And now? Now it's sitting here, compressed, quiet, coiling between 3 levels that were drawn on this chart before today's candle even opened. $70,600 at the top, $67,000 in the middle, $62,700 at the bottom. 3 lines, 3 possible futures. So let me ask you something before we go any further. Look at this chart one more time. 3 lines, 3 levels. One question, what are you going to do in each scenario? Not what you think you should do, not what the right answer is. What you, right now, with your current position, your current emotional state, your current bank account, are actually going to do when one of these 3 things happens. Because this chart is going to resolve. It always does. And there are only 3 places it can go from here. Scenario 1, Bitcoin breaks above $70,600. The compression ends. The squeeze begins. The shorts that have been stacking up above that line get forced to cover. Price moves fast. The news cycle flips overnight. Suddenly every headline says Bitcoin recovery. Your phone starts buzzing with messages from people who swore off crypto 3 weeks ago. Stop right now. What do you do? Do you chase the breakout because you've been waiting anxiously and now feel like you're missing it? Do you execute a pre-planned entry with a defined size because you identified this level days ago? Or do you feel nothing because you've been accumulating all the way down and a breakout just means your thesis is playing out on schedule? Scenario 2, Bitcoin loses $62,700 on a daily close. The support fails. The next visible floor is $58,000, the 200-week moving average. The headlines return. Crypto winter, institutional exit, the whole script. Fear and greed drops below 10. Your portfolio is deep red. Stop right now. What do you do? Do you panic sell to stop the bleeding, turning a paper loss into a permanent one right before the bottom? Do you move your stop loss to 57,000 and wait for confirmation of the next structure? Or do you open your dollar cost averaging app, increase your weekly buy, and feel a quiet satisfaction that the market is offering you more of what you already decided you wanted? Scenario 3, Bitcoin goes nowhere for 6 more weeks. No breakout, no breakdown. Just this same compression. 63, 66, 64, 67. Candle after candle, week after week, all the way through March and into April. No resolution, no clarity. Stop right now. What do you do? Do you get bored and impatient and start making emotional decisions? Adding leverage, switching to altcoins, convincing yourself the thesis is broken? Do you tighten your levels and wait, knowing that the longer the coil compresses, the more explosive the eventual move? Or do you not even notice, because your time horizon is measured in years, not weeks, and 6 weeks of sideways is simply noise? Your answers to those 3 questions tell you exactly who you are in this market. Not because of which scenario plays out. The market doesn't care which one you were hoping for, but because of how you felt reading all 3 of them. If any of those scenarios made you anxious, if your stomach tightened reading about the breakout you might miss, or the support level that might fail, or the weeks of silence that might drain your patience, you are an amateur speculator. And I don't mean that as an insult. I mean it as a diagnosis. The amateur speculator is not stupid. He's not uninformed. He read the thesis. He understood the narrative. But he entered the market with a time horizon he never actually committed to, a position size his emotions can't survive, and a plan that only works if the price goes up quickly. He checks the price 14 times a day. He reads every thread on Twitter as if it's new information. He sells when it drops and buys back higher. He confuses activity with strategy. And when any of these 3 scenarios hits, breakout, breakdown, or sideways, his first instinct is to react, to do something. Because doing nothing feels like losing control. And that instinct is exactly what the market is designed to exploit. If you read all 3 scenarios and immediately started thinking about levels, entries, confirmation signals, and where your stop goes, you are a trader. You're not reacting to the chart. You are preparing for it. That is a fundamentally different relationship with uncertainty. The trader doesn't need to know which scenario plays out. He needs a plan for each one, and he already has it. The danger for the trader is not emotion, it's overconfidence in the setup when the institutional order flow doesn't care about his levels. And if you read all 3 scenarios and felt essentially the same way through all of them, not because you don't care, But because your decision was already made long before this chart appeared on your screen, you are a long-term investor. The long-term investor's relationship with these three scenarios is almost boring. Breakout? His thesis is playing out. Breakdown to 58,000? He buys more. 6 weeks sideways? He doesn't notice. The chart does not change his behavior. Only the opportunity size changes. And in scenarios 2 and 3, the ones that scare everyone else, his opportunity is the biggest. Same three scenarios, same chart, same data, 3 completely different internal experiences, 3 completely different outcomes over the next 12 months. Now, which one are you? Before anything else, drop a comment right now with your city and one word: panic, hold, or buy. I want to see in real time how this community is reacting to $65,000. And hit that like button if you already have a feeling that something doesn't add up about this crash. Because what I'm about to show you is not what the headlines are saying. Subscribe. The next 20 minutes will change how you read every Bitcoin dip from here on out. And that's exactly what this video is about. But before we get into the data, before I show you the institutional flows, the on-chain signals, and the macro forces driving this chart, I want to introduce you to 3 people. Because data without a human face is just numbers. And numbers don't change behavior. Stories do. Meet Marcus. Marcus is the amateur speculator. He's 27 years old. He bought Bitcoin at $118,000 in October of 2025, using a 3 times leveraged position. He heard about it from a friend. He read 2 articles. He watched 1 YouTube video. And he was convinced. He understood the thesis. Digital gold, fixed supply, institutional adoption. He wasn't wrong about any of that. He was wrong about one thing. He thought understanding the thesis was the same as having a plan. Right now, Marcus checks his portfolio every 14 minutes. He's not looking for information. He's looking for permission to feel okay. Every green candle gives him temporary relief. Every red candle confirms his worst fear. That he made a mistake, that he should have waited, that everyone else knows something he doesn't. When Marcus looks at this chart, he sees one thing: the bottom line. $62,700. Because that's where his pain gets worse. Meet David. David is the trader. He's 38. He's been doing this for 6 years. He doesn't have a leveraged position right now. He closed it 2 weeks ago when Bitcoin lost the 50-week moving average at approximately $102,000. He took a loss. He documented it. He moved on. Right now, David has 3 scenarios mapped out on his chart. He knows exactly what he's going to do if price breaks above 70,600. He knows exactly where his stop goes if it loses 62,700. He's not anxious. He's not excited. He's waiting. When David looks at this chart, he sees the coil, the compression, the energy building on both sides. He doesn't know which way it breaks, but he knows what he does when it does. And that's enough. Meet James. James is the long-term investor. He's 44. He first bought Bitcoin in 2020 at $30,000. He bought more in 2022 at $16,000. He bought more in 2023. He bought more last week. James has not checked the price today. He might check it this weekend. He has a recurring buy setup that executes automatically every Monday morning, regardless of what the chart looks like. When Bitcoin was at $126,000, his recurring buy executed. When Bitcoin was at $65,000, his recurring buy executed. The amount was the same. The emotion was the same, which is to say, there wasn't any. When James looks at this chart, he sees one thing: time. And he has plenty of it. 3 people, 3 completely different relationships with the same asset. 3 completely different outcomes coming. Now here's what makes this moment different from every other dip, every other chart, every other video telling you to zoom out and be patient. The data underneath this chart is not neutral. While Marcus has been panic refreshing his portfolio app, something has been happening in the background that mainstream media is not showing him. Something that changes the entire context of what this chart actually means. And that's what we're going to look at right now. Comment below. Are you Marcus, David, or James? Be honest. Nobody's judging. The comments on this question are always the most interesting thing in the whole video, because now I'm going to show you the actual data, and you'll see it through completely different eyes, depending on which one you just admitted to being. Let me show you exactly what happened in the last 24 hours. Not the narrative, the mechanics. The setup. According to CoinGlass heat map data and order flow analysis from Bybit and Binance, the most dense liquidity clusters in the market were sitting at 2 specific zones: $65,000 to $66,000. Concentrated long positions, leveraged retail longs who entered on the strong support narrative, $67,000 to $72,000. Short positions stacked, traders who shorted the bounce expecting continuation down. Both pools were visible, both were known. And institutions, The entities with enough capital to move price deliberately could see exactly where the maximum pain was located. What happened? Price swept aggressively through the $65,000 to $66,000 zone. $178 million in long positions liquidated in 24 hours. Isolated liquidations of $2 million or more on Bybit and Binance appeared precisely on top of the retail stop-loss clusters. Shorts barely touched. The move was not a breakdown. It was a precision instrument. Bitcoin did not close below $64,800 on a daily basis. The wick went exactly to the pool of liquidity and reversed. Classic bear trap architecture: hunt the weak, absorb the supply, prepare the squeeze. What this means for each character: Marcus sees Bitcoin broke $65,000 support. It's going lower. Panic sell. David sees stop hunt, wick below support. Watch for reversal confirmation. Possible long setup. James sees nothing. He's not watching the chart. He's at dinner. Marcus just funded the institutional entry. David is trying to time the reversal. James will find out about this in a monthly portfolio review and feel nothing. Question 3. When you saw Bitcoin at $65,000 on your screen today, did you check it once or every few minutes? The frequency of your price checking is one of the most accurate behavioral signals of which type you are. James checks portfolios. Marcus checks prices. There's a difference. Here is the single most important data point in this entire video. And it's the one that mainstream media is getting completely wrong. What the headlines say: BlackRock IBIT outflows, negative $84.2 million on February 18th, 2026. Fidelity FBTC outflows, negative $49 million on February 18th. Total spot ETF outflows, negative $133 million on the day, negative $237 million on the week. CNBC reads this data and says institutional investors are leaving Bitcoin. The fear and greed index drops to 12. Retail panics. Now here's what CNBC is not showing you. What the on-chain data shows. MicroStrategy purchased 2,486 Bitcoin for $168 million in the last week. Average price, $67,700. Total holdings, 717,131 Bitcoin. Metaplanet holds 35,102 Bitcoin. Raised capital in January 2026 specifically to buy more. Target, 210,000 Bitcoin by 2027. Not selling a single coin. New and large whale addresses holding between 1,000 and 10,000 Bitcoin accumulated 170,000 Bitcoin in 2026 so far. Santiment on-chain data. Exchange reserves, not rising. If retail was truly dumping en masse, exchange inflows would spike. They haven't. Long-term holder UTXO, not moving. The hands that matter are not selling. Here's what's actually happening. The ETF outflows represent one type of institutional money. Call it dumb institutional. Hedge funds, risk parity funds, and momentum-following allocators who treat Bitcoin like a tech stock. When risk-off hits, they reduce exposure, algorithmically, without conviction. The corporate buyers, Strategy, Metaplanet, the new wave of Bitcoin treasury companies globally, are a completely different category. They have a 5 to 10 year horizon. They don't rebalance on fear. They accumulate on weakness. Michael Saylor last week, while IBIT was bleeding, we buy Bitcoin. 2 words, $168 million. The divergence decoded. Dumb institutional. ETF retail flows, selling at $65,000 to $67,000. Smart institutional. Corporate treasury, buying at $65,000 to $67,000. Ancient whales dormant for 7 to 13 years. Moving occasionally, absorbed silently. New big whales accumulating in 2026. Buying everything retail drops. Marcus watches ETF flows and concludes institutions are leaving. James watches corporate treasury activity and concludes the people with the longest time horizons are loading up. Same data, opposite conclusions. Because they're different people with different identities. Question 4. Did you know, before this video, that Strategy bought $168 million in Bitcoin this week while the headlines said institutions were selling? If you didn't know that, it's not your fault. It's by design. The information that scares retail into selling is amplified. The information that tells you why smart money is buying is buried in filings and on-chain data. That's the trap. The liquidity hunt didn't happen in a vacuum. It was enabled, maybe even designed to benefit from, a very specific macro environment. And understanding this macro layer is what separates James from everyone else. The yen carry trade. Unwind. The Bank of Japan has been normalizing rates. hiking from 0% toward a 0.75%, with more hikes expected in 2026. This is unwinding the yen carry trade, the mechanism by which cheap Japanese capital was borrowed and invested in risk assets globally, including Bitcoin. As that capital repatriates, as the yen strengthens and the carry trade becomes less profitable, risk assets get sold, not because they're broken, because the financing vehicle that funded their purchase is closing. Bank of Japan rate, 0.75%, the highest in 30 years. More hikes projected. Estimated yen carry position still active, $500 billion. Morgan Stanley. U.S. 10-year yields rising plus hawkish Fed language equals dollar strength equals risk off globally. Bitcoin fell alongside tech stocks because in this environment, Bitcoin trades as a risk asset. That's the ETF securitization effect. It's not a fundamental problem with Bitcoin. It's a plumbing problem with how Bitcoin is now embedded in the traditional financial system. Why smart money is grateful for this dip. The institutions that wanted to accumulate more Bitcoin at a discount needed a catalyst to force retail to sell. The macro environment, yen unwind, rising yields, hawkish Fed, provided exactly that catalyst. The move from $70,000 to $65,000 was the price needed for institutions to enter more cheaply after already buying heavily in 2024 and 2025. The macro forced the flush. Smart money says, thank you. The on-chain reality check. Exchange supply, structurally low, not rising despite price drop, Glassnode. Long-term holder behavior, no mass distribution. UTXOs of 1 year or more unchanged. Realized price, approximately $54,900 to $56,000, the structural floor where the cost basis of the majority of holders sits. Ancient whale moves, 909 Bitcoin from a 13-year-old wallet, 2,000 Bitcoin from a 7-year-old wallet. Absorbed without price impact, sign of deep institutional buying underneath. Realized losses on-chain, $5.4 billion per day at the peak of the recent sell-off. Historically marks late-stage capitulation, not the beginning of a crash. For Marcus, this is terrifying because he doesn't know when it ends. For David, it's a setup to analyze. For James, it's context that explains why on-chain fundamentals remain intact, even as the price gets compressed. We've covered the data, the liquidity hunt, the smart money divergence, the macro setup. Now let's bring it back to the most important question of the video. Based on everything you've seen, who are you, and what does that identity tell you to do right now? If you are Marcus, and you're honest about it, first, close the leveraged position. Not because Bitcoin is going to zero, it isn't, but because leverage in a bear trap environment is designed to extract your capital before the squeeze happens. The institutions that set this trap are patient. Marcus's margin call is not. Second, decide your actual time horizon. If you cannot hold through a potential move to $50,000 or even $45,000 without psychological damage, you are using more capital than you can afford to risk. That's not a market problem. That's a position sizing problem. Third, write down the price at which you will no longer be able to sleep. That's your real risk tolerance. Build your position around that number, not around your conviction in the thesis. If you are David, and you've read the chart correctly. The technical setup right now is a textbook bear trap with potential squeeze architecture. Key levels to watch. $64,800, the actual daily close floor. If Bitcoin does not close multiple consecutive days below this level, the trap thesis holds. $58,000, the 200-week moving average. If price reaches here, it's a generational long setup for patient traders, but it will feel apocalyptic when it happens. $72,000 to $75,000, the resistance zone where shorts stacked up. A breakout above this level triggers forced short covering, the squeeze. David's edge here, the on-chain data says smart money is absorbing. The institutional data says corporate buyers are loading. The technical data says the wick to $64,800 was a precision stop hunt. These three data sources align. This is a high probability setup, but not a guaranteed one. There's one behind studies. If you're James, this is your moment. James already knows what to do. He's known since he built his thesis. The question isn't what to do. It's whether he has the emotional infrastructure to actually execute it. James's checklist right now. Dollar cost average still running? Good, don't change it. Have extra capital saved for a dip? This is the dip you saved it for. Feeling the urge to check the price every hour? That's the Marcus inside you asking to be heard. Acknowledge it, then close the app. Reading CNBC headlines about crypto winter? Remember, Strategy just bought $168 million this week. Metaplanet is targeting 210,000 Bitcoin. The people with the longest time horizons are not acting like it's winter. For James, $65,000 is not a problem, it's a gift. Question 5. The most important question of this video. What would you do differently right now if you were 100% certain Bitcoin would be at $250,000 in 5 years? Think about that. If you had certainty, not hope, not speculation, actual certainty, that Bitcoin would be at $250,000 in 60 months, what would your behavior at $65,000 look like right now? You would not be panicking. You would not be checking the chart every 4 minutes. You would not be reading headlines about crypto winter. You would be accumulating as aggressively as your position sizing allows. James doesn't have certainty. Nobody does. But James's thesis, based on scarcity, corporate adoption, sovereign interest, macro conditions, creates enough conviction to behave as if the probability is high enough to act on. That's the difference between investing and gambling. Marcus needs certainty before acting. James acts on probability. David acts on setup. Different identities, different outcomes over 5 years. Here are the specific signals that will tell you the bear trap is executing as designed, that the squeeze phase has begun. Signal 1, price structure. Bitcoin holds above $64,800 on daily closes for 5 or more consecutive days. Trap confirmed. Bitcoin breaks above $70,000 with volume. Short squeeze initiating. Bitcoin breaks above $75,000. Forced short covering begins. The squeeze becomes self-reinforcing. Signal 2, ETF flows. Reversal. Watch for IBET and FBTC returning to net positive inflows for 3 consecutive days. A single day of positive $200 million or more in inflows after this outflow period. Institutional reentry signal. Signal 3, corporate treasury announcements. Any new public company announcing a Bitcoin treasury strategy in the next 30 days. Strategy announcing another purchase above $100 million. Sailor signaling continued conviction at current prices. Signal 4, on-chain accumulation. Exchange outflows accelerating. Bitcoin leaving exchanges means fewer coins available to sell. Accumulation phase active. Whale address count for wallets, holding between 1,000 and 10,000, Bitcoin increasing. New large buyers entering. Realized price holding above $54,900. No mass underwater selling. Signal 5, the macro trigger. Any Fed pivot language? Rate cut signals, quantitative tightening pause, equals liquidity returning to risk assets. USD JPY breaking below 150. Yen carry unwind potential peak signal. Bank of Japan, pausing rate hikes, relief for carry trade funded risk assets globally. James monitors these signals not to time the market, but to confirm that the thesis is intact. David uses these signals as entry and exit triggers. Marcus ignores them and reacts to price alone. Bitcoin at $65,000 is not a crash. It's an engineered liquidity event. $178 million in retail longs swept in 24 hours, precisely at the stop-loss clusters that every analyst on Twitter told you were strong support. The institutions that set that trap are now sitting on cheaper Bitcoin than they held last week. The ETF outflows, $133 million in a single day, are real. They represent risk-averse institutional capital reducing exposure in a risk-off macro environment. But they are not the full picture. The full picture also includes strategy buying $168 million this week. Metaplanet targeting 210,000 Bitcoin. New whale addresses accumulating 170,000 Bitcoin in 2026 so far. Ancient whales moving coins that were absorbed without price impact. The macro environment, Bank of Japan normalization, US yield pressure, yen carry unwind, created the conditions for the flush. The flush created the entry point. The entry point is being used right now by the entities with the longest time horizon and the most capital. And Marcus, using 20 times leverage on a strong support level, he funded that institutional entry, involuntarily, precisely. That's what bear traps do. The final identity. Check. Go back to question 1. If Bitcoin drops to $50,000, what is your immediate emotional reaction? You know more now than you did 22 minutes ago. Does your answer change? If you were Marcus and now want to become James, the first step is not buying more Bitcoin. The first step is removing the leverage, setting a time horizon you can actually commit to, and building a position size you can hold through 50,000, 45,000, or whatever the market decides to do next. If you were already James and felt unnecessary anxiety at $65,000, you now have the data to reinforce your thesis. The The on-chain fundamentals are intact. The corporate adoption is accelerating. The supply is being absorbed. Your job is to hold your identity. If you're David and you see the bear trap set up, the signals are clear. Watch the levels, manage the risk. The setup is there. But respect the macro until it changes. Drop a comment with 3 things: your city, which character you identified with most, Marcus, David, or James, and the one signal from section 6 you're going to watch starting today. Hit that like button if this video changed how you see what's happening at $65,000. Not the price, the mechanics behind the price. That's the difference between watching the market and understanding it. Subscribe, because I'm tracking every one of these signals in real time. Most people clicked away long ago, distracted by the noise. But you stayed for the signal. Reaching this point shows a level of commitment that most retail investors simply don't have. If you've understood the institutional trap we discussed today, show me you're part of the resistance. Comment, I am still here. Let's show the algorithm how strong this community is. Thanks for watching. See you in the next one.